Good evening, all. It's Sunday night. Hope you had a great weekend. Hope you're able to relax. This is a holiday week this week, so it's going to be a very, very short week. Market is going to be closed on Thursday. Friday's going to be half day. Wednesday is basically going to be useless because everybody's going to be traveling and getting prepared for the holiday. So, be prepared for that. It's going to be a very difficult week to trade, although it could be very profitable if you catch the right moves because during slow weeks, market can move very, very well as well. I want to show you what the S&P 500 is developing right now because this is extremely important. Before I show you what it's developing right now, I want to show you what it did exactly a year ago. This is December 31st, right at this point. And this is December 31st, right at this point, and you can see the kind of wedge consolidation we had going into the new year. After that, we had a heck of a trend coming out of it. That's what you're looking for. You're looking for these kind of big, large trends that start that move really well. Fast forward a little bit, you can see that trend actually started this really, really long-term trend. So from 1400, 1450 all the way down to the 800 level, that is quite a bit of profit. So what's the market doing right now? Well, it's basically doing the same thing. It's preparing, it's consolidating, preparing, and so on. Which way is it going to go? You can see the preparation over here. You can see the wedge of consolidation. Which way is it going to go? Well, if it penetrates resistance, it's going to go up. If it penetrates support, it's going to go down. Which way is it going to go? I don't know. I have an upward bias myself. I think the market is going to go up, but you never know. There's quite a few forces that are going through the market right now. One of the biggest ones is the hedge funds. That's something that most people don't realize is the significant effect of hedge funds on the market. We've had more triple-digit days, more volatility right now than ever before. Our average true range, the range of every day is absolutely enormous. Let me see if I can put that indicator on for you. And there we go, average true range. This indicator shows the range of the day, and you can see it's absolutely enormous. Let me show you this on a weekly chart. There's a weekly chart. We've never been up this high, even back over here, back in the 2000s when the market was much, much higher. Market was at 1,500, now we're at 800, and the size of our days is larger. And there's a very interesting reason for that. Hedge funds. Now, most people don't understand how hedge funds get paid. Hedge funds get paid 2% a management fee, so 2% based on assets, and then they get 20% of profits, whatever profits they generate. So it's 220. Now, there's also hedge funds of hedge funds where they tap on an extra 1% of fees plus an extra 10% of profits, and that's a totally different story, but we won't get into that. So anyway, so hedge funds are getting 2 and 20, but they are down 40% for this year. Now, if you're down 40% for this year and most of your money comes from profits, what do? Well, if you're going to have stellar years for the next 3 years, you might actually start making money. So which means that for the next 3 years, hedge funds are not going to make any money. Hedge fund managers are not going to make any money. They are much, much better off closing their funds, liquidating their funds, selling everything, closing everything if they're short, and coming out of the market, and then starting a new hedge fund so they can start from scratch, so they can get their 20% again. What that's creating this kind of volatility where we have triple digits every day because they're coming in and they're buying. There's also one more reason why we have this triple digit days, and that's the ETFs. We have so many of them right now that are not just the market. For example, SSO. SSO is ProShares Ultra S&P 500. This one is double the S&P 500. Whatever the market does, it will do exactly double because it's actually on margin. SDS is exactly the same thing, but on the short side, it's ultra short, which is really interesting, and that's why you see the kind of volatility on this kind of fund. It's very difficult for them to come in and out. Now, when a fund mimics the S&P 500, they actually have to buy stocks exactly like the S&P 500. So if you go invest, let's say $100,000 into an ETF fund like that, they actually have to go in and buy that much of the market. So whatever the market moves, whenever the stock market starts moving and things change, they have to go in and they buy. Whenever the market moves down, they have to go in and go short. that actually exaggerates the volatility of the market. I think that there's so much money on the sidelines right now, after all these liquidations, that they're going to have to start buying pretty soon. And that's why I think we're going to go on the long side. This is the NASDAQ 100, NDX, basically the same thing. You can also see the kind of volatility we've had. And then you can see the wedge-shaped consolidation right here. And I think we're going to go back up. I think. I don't know. I'm prepared to go short or go long. The thing about it is I'm finding quite a few stocks that have been beat up. That, $60 stocks, $70 stocks, they're sitting right at $5 right now. They look very, very tasty for the long side. And that's what I'm recommending to our daily clients, to our swing trading newsletter, is a ton of stocks that look great at $5 that could double. That's a nice thing about it, because the market has so much room to go on the long side. Dow Jones Industrial Average, basically the same thing. You can also see the tremendous size of the bars, tremendous true range of every day, tremendous. You can see the wedge-shaped consolidation in that. 9,000 being our resistance level. So if we break the 9,000, I think we're going to go up. So what do? How do you trade this? If you're a long-term investor and you are trying to buy into the market over the last couple months since October, you're getting ripped apart. Why? Because of the size of the bars and the fact that the market really hasn't gone anywhere since October. There's October, there's December. We are still stuck in one area. Your job as an investor or long-term trader or whatever is to look for the next big trend. You want the market absolutely move. You want the market to actually break this way or break this way, whichever way. But you do not want to try and enter while the market is moving sideways. That's a mistake, because you're just getting ripped apart by the volatility. Here's my suggestion. The Spiders. The Spiders is an ETF, basically, and it works pretty well. And you can look at it on the long side if it breaks this level, and look at it on the short side if it breaks this level. Now, our daily newsletter, our daily videos, will actually give the exact entry points and the exact trades as they come. But for now, I'm going to give you the 92.67 level on the Spiders for the long side. Next week, I'm probably going to give you a little bit more updated information. The QQQ is ProShares. That's based on the S&P 5, on the NDX, NASDAQ 100. It's actually based on the it's NASDAQ 100. So 30.77 would be the level on this one. You can see the wedge-shaped consolidation. I think something's going to happen by the end of the year. I think you have to be in or looking by the end of New Year's. And be prepared for a large trade. If it penetrates over here and it goes over here from 30 up to 40, that's 33%. You do not want to miss on a 33% trade. If it goes from the $28 level all the way back to the lows, it's still a pretty significant trend and quite a bit of money there. Be prepared for holiday week, though. You want to be prepared. You want to have your trades in place. You want to have your trading plan in place and be prepared for the next trend. Anyway, have a great week. Have a great holiday. Whichever holiday you celebrate, have a great holiday. Spend time with the family. That's the most important thing. I'll talk to you next week. Take care.